Thank you for being here today. I can share what I've learned in 80 plus years of investing and what I've observed about how wealthy people protect what they've built. I've spent most of my life thinking about how to build wealth, but the older I get, the more I realize that building wealth is only half the battle. The other half, maybe the more important half, is protecting it. Because here's the truth, it's a lot easier to lose a fortune than to make one. I've watched people who made millions, tens of millions, even hundreds of millions, lose it all through bad decisions, bad luck, or bad behavior. And I've watched people with modest fortunes protect them carefully, grow them steadily, and pass them on to the next generation. The difference isn't usually intelligence or luck. It's understanding the difference between getting rich and staying rich. When you're trying to get rich, you're playing offense. You're taking calculated risks, you're building businesses, you're investing aggressively. But once you've accumulated real wealth, the game changes. You shift to playing defense. Your primary goal becomes not losing what you have, because every dollar you lose is a dollar that can't compound for you anymore. Now, most people confuse volatility with risk. They see their portfolio drop 20% in a market downturn and they think they've lost money. But that's just volatility. That's price fluctuation. That's Mr. Market being emotional. Real risk is permanent loss of capital. Real risk is making an investment that goes to zero and never comes back. That's what you need to protect against. Today, I'm going to walk you through the tactics the wealthy use to protect their fortunes. These aren't secret exactly. They're just not talked about much because they're not exciting. Protection strategies are boring. They're defensive. They don't make for good cocktail party stories, but they're absolutely critical if you want your wealth to last. Let me start with the mindset, because everything flows from how you think about risk and protection. The first concept is what Charlie Munger and I have always called the circle of competence. You need to know what you know, and just as importantly, know what you don't know. The wealthy stay wealthy by operating within their circle of competence and admitting when something is outside it. I don't invest in biotechnology companies because I don't understand drug development. I don't invest in complex derivatives because I can't explain them simply. I stick to businesses I understand: consumer products, insurance, banking, railroads, utilities, businesses with straightforward economics. When you operate outside your circle of competence, you're gambling, not investing. And gambling is how fortunes are lost. The second concept is margin of safety. This is something I learned from my teacher, Ben Graham. Never pay full price for anything. Always insist on a discount, a buffer, a cushion that protects you if you're wrong. If you think a business is worth $100 a share, don't buy it at $100. Wait until it's $70 or $60. That margin of safety protects you if your analysis was too optimistic, if the business hits unexpected problems, if the economy turns down. It's your buffer against error and misfortune. The third concept is temperament. The wealthy have trained themselves to be unemotional about money. They don't panic when markets crash. They don't get euphoric when markets soar. They maintain an even temperament and stick to their principles regardless of what everyone else is doing. This is harder than it sounds. Humans are emotional creatures. We're wired to panic in groups and to follow the herd. But wealth is protected by those who can override those instincts and stay rational when everyone else is losing their minds. Now let me talk about the actual playbook for capital preservation, the specific tactics wealthy people use. First, position sizing and concentration discipline. How much of your wealth do you put into any single investment? The wealthy think carefully about this. They concentrate enough to make meaningful returns, but they never put so much into any single position that if it fails, it devastates them. I've always believed in concentration over excessive diversification. Charlie used to say that wide diversification is only required when investors don't understand what they're doing. If you know what you're doing, owning 5 to 10 excellent businesses makes more sense than owning 50 mediocre ones. But here's the key. Even with concentration, you never bet the farm. Even if you're absolutely convinced something is a great investment, you still size the position so that if you're wrong, you survive. You live to invest another day. Second, cash buffers and liquidity. The wealthy always keep cash available. not because they're scared, but because cash is optionality. Cash means you never have to sell something you don't want to sell. Cash means you can take advantage of opportunities when they arise. Cash means you can sleep at night even when markets are crashing. I've always run Berkshire Hathaway with significant cash and short-term treasury bills. We've never had less than $20 billion in cash, usually much more. People sometimes criticize this, saying we're not putting all our money to work. But that cash has allowed us to make deals during every crisis, 2008, 2020, whenever everyone else is desperate for liquidity. For an individual investor, I'd suggest keeping at least 1 to 2 years of living expenses in cash or cash equivalents if you're retired, or at least 6 months of expenses if you're still working. This buffer means you never have to sell stocks at the worst possible time. Third, avoid leverage. This is absolutely critical. Leverage, borrowing money to invest, is how most fortunes are lost. I've seen more people destroyed by leverage than by bad investments. Here's why leverage is so dangerous. When you borrow money to invest, you create the possibility of forced selling. If your investments drop in value, your lender can force you to sell at exactly the wrong time. You lose control. A temporary market downturn becomes a permanent loss of capital. I've used leverage very sparingly in my entire career, and only when I was absolutely certain I could service the debt under any circumstances. For most people, leverage should be avoided entirely, with the possible exception of a mortgage on a home you can truly afford. Margin calls, forced liquidations, that's how intelligent people with good ideas end up broke. Don't let it happen to you. Fourth, stress testing and scenario planning. The wealthy constantly ask themselves, what if I'm wrong? What if this goes badly? What if there's a recession? What if interest rates spike? What if my largest position gets cut in half? You need to think through worst case scenarios and make sure you can survive them. If a 50% market crash would devastate you psychologically or force you to sell, your portfolio is too aggressive. If losing your biggest position would wipe you out, you're too concentrated. The goal is to structure your wealth so that even in terrible scenarios, you're uncomfortable but not destroyed. You can ride out the storm without panic selling. Now let me talk about quality, because this is where protection really begins, with what you own. Charlie taught me something profound that changed how I invest. He said it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This seems subtle, but it's revolutionary. When I was younger, I'd buy mediocre businesses because they were statistically cheap. And sometimes I made money, but it was hard work and the returns were just okay. When I started buying wonderful businesses, even if I paid reasonable prices, the returns were far better and required far less work. What makes a business wonderful? It has what we call a durable competitive advantage, or a moat, something that protects it from competition and allows it to earn high returns on capital for decades. There are a few types of moats. Brand is one. Coca-Cola has been around for over 130 years. People trust it, love it, and will pay a premium for it over generic cola. That brand is worth billions, and it's incredibly durable. Network effects are another moat. The more people who use a platform, the more valuable it becomes to everyone else. This creates a self-reinforcing advantage. Cost advantages are a moat. If you can produce something cheaper than anyone else due to scale or location or technology, you have pricing power and margin protection. Switching costs are a moat. If it's expensive or difficult for customers to switch to a competitor, you have them locked in. Think about enterprise software, banks, insurance companies. Once customers are in, they tend to stay. When you own businesses with durable moats, you're protected because these businesses can maintain profitability even during tough times. They have pricing power, they have loyal customers, they have competitive advantages that persist. The other critical element of quality is management. You want owner-oriented managers who think like owners, who make decisions for the long term, who allocate capital intelligently, and who are honest and competent. Bad management can destroy even a great business. Good management can compound value for decades. When I evaluate an investment, I spend as much time thinking about management as I do thinking about the business itself. Let me give you a concrete example. When we bought Coca-Cola stock in 1988, we paid about $1.3 billion. That first year, they paid us about $75 million in dividends. Fast forward to today, over 35 years later, and Coca-Cola pays us over $700 million annually in dividends. Same shares, 10 times the income. That's what a wonderful business with a durable moat and shareholder-friendly management does. The cash flow grows year after year, and if you're patient enough to hold it, the compounding is extraordinary. Or look at Apple, which we started buying in 2016.
Apple has one of the most valuable brands in the world, an ecosystem that locks in customers, incredible pricing power, and management that returns massive amounts of cash to shareholders through dividends and buybacks.
Even though we paid what seemed like high prices at the time, it's been one of our best investments because the business quality is exceptional. Quality protects you. When you own wonderful businesses, you don't have to worry as much about temporary setbacks because you know the underlying economics are strong and durable. Now let me talk about something that quietly destroys wealth: costs, taxes, and friction. Most people dramatically underestimate how much fees erode returns over time. Let me show you the math, because it's shocking.
Let's say you invest $1 million. Your investments earn 10% annually before fees. You plan to invest for 30 years.
Scenario 1, you pay 0.05% annually in fees, which is what a low-cost index fund charges. After 30 years, you have about $17.2 million. Scenario 2, you pay 5% annually in fees, which is typical for actively managed funds or financial advisors who charge assets under management. After 30 years, you have about $11.5 million. The difference is $5.7 million. You gave away almost $6 million to financial intermediaries for what is usually worse performance than you'd get from a simple index fund. This is why I've been recommending low-cost S&P 500 index funds for decades. You get instant diversification across 500 of America's best companies. You pay almost nothing in fees, and you'll likely beat 90% of professional investors over time. The wealthy understand that every dollar you pay in unnecessary fees is a dollar that can't compound for you. They're ruthless about minimizing costs. Taxes are similar. Every dollar you pay in taxes is a dollar you can't invest. This doesn't mean you should do anything illegal or even aggressive, but it does mean you should be thoughtful about tax efficiency.
One of the most tax-efficient strategies is simply holding investments for a very long time. Our favorite holding period is forever. When you buy and hold, you defer taxes indefinitely.
Those tax dollars stay invested and compound. Eventually you might pay taxes, but you've had decades of compounding in the meantime. Compare this to someone who trades frequently. They're paying short-term capital gains taxes, which can be as high as ordinary income rates. They're paying taxes every year instead of deferring them. Over a lifetime, this difference is enormous. This is another reason I love index funds. They have very low turnover, so they generate minimal taxable events. You can hold an index fund for 40 years and only pay taxes when you eventually sell. Now let's talk about diversification, because this is widely misunderstood. I'm not a fan of what Charlie called diversification, owning so many different things that you have no idea what you own and you can't possibly track it all. That's not diversification. That's just chaos. But I am a fan of intelligent diversification. You want to own enough different assets that no single failure can destroy you, but not so many that you dilute your returns and can't keep track of them all. For most people, a mix of stocks, bonds, and cash makes sense. The exact allocation depends on your age, risk tolerance, income needs, and other factors. But the principle is to spread risk across different asset classes that behave differently in different economic environments. Stocks do well when the economy is growing and businesses are profitable. Bonds do well when interest rates fall or when investors flee to safety. Cash is stable but loses purchasing power to inflation. By owning all three, you smooth out the ride and reduce the chance of devastating losses.
The wealthy also practice disciplined rebalancing. Let's say your target allocation is 60% stocks, 30% bonds, 10% cash.
If stocks have a great year and now represent 70% of your portfolio, you sell some stocks and buy bonds and cash to get back to your target. This forces you to sell high and buy low, which is exactly what you want to do, but emotionally very difficult. By having a mechanical rebalancing rule, you remove emotion from the equation. I'd suggest setting rebalancing bands. Maybe you rebalance when any asset class gets 5 or 10 percentage points away from its target. This prevents you from rebalancing too often, which generates taxes and trading costs, but ensures you rebalance when things get significantly out of whack. For the bond portion of your portfolio, focus on quality, short to intermediate term investment grade corporate bonds or treasury bonds. You're not trying to hit home runs with your bonds. You're trying to preserve capital and provide stability. Think of bonds as your sleep well at night money. And here's something important. Owning productive assets protects you from inflation. Cash loses purchasing power over time. Bonds can be hurt by inflation if interest rates rise. But businesses can raise prices. If inflation drives up the cost of Coca-Cola's inputs, they raise the price of Coke. Your ownership stake in that business retains its real value. This is why even older investors should maintain significant stock exposure. You need inflation protection for what could be 30 years of retirement. Now, let me talk about crisis management, because how you behave during crises determines whether you protect your wealth or lose it. I've lived through every major crisis since the 1,940 seconds. I can tell you exactly what I did during each one, and more importantly, what I didn't do. During the 1973 to 1,974 crash, when the market dropped nearly 50% and everyone was in despair, I was buying. I didn't panic. I didn't sell. I looked for bargains and I bought them. In 1987, when the market dropped 22% in a single day, I stayed calm. I knew the businesses I owned hadn't changed in value overnight just because Mr. Market was having a panic attack. In 2008, during the worst financial crisis since the Great Depression, Berkshire made some of the best deals we've ever made. We invested in Goldman Sachs, General Electric, Bank of America, all at very favorable terms. Why? Because we had liquidity when no one else did. We had cash to deploy when everyone else was desperate to raise cash. In March 2020, when COVID hit and the market crashed 34% in less than a month, I stayed patient. I didn't panic sell. I evaluated opportunities carefully. The pattern is always the same. Be fearful when others are greedy, and be greedy when others are fearful. This isn't just a catchy phrase. It's an operating principle. Here's how to apply this in practice. During calm times, maintain a watch list of companies you'd love to own at the right price. Know what they're worth, know what price you'd pay. When a crisis hits and prices crash, consult your watch list. If something you've always wanted to own is now available at a bargain price, and you have cash available, buy it. Don't try to catch the exact bottom. Don't wait for perfect clarity. Just buy good things at good prices when fear is high. What you don't do is panic and sell everything. What you don't do is try to time the market. What you don't do is abandon your plan and make emotional decisions. The wealthy protect their fortunes during crises by staying calm, maintaining liquidity, and having the courage to act when prices are attractive. Now, let me talk about practical protections that have nothing to do with investments but are critically important for protecting wealth. Insurance is the first layer of defense. You need adequate insurance across multiple areas: homeowners insurance, auto insurance, health insurance, and critically, umbrella liability insurance. Umbrella policies are cheap, usually a few $100s a year for $1 million or more in coverage, and they protect your assets from lawsuits. In our litigious society, anyone with significant wealth needs this protection. If you own a business, you need proper business insurance: general liability, professional liability, property insurance, workers' compensation if you have employees. Don't be penny wise and pound foolish. Pay for adequate coverage. Asset titling is another important protection. How you title assets in your own name, jointly with a spouse, in a trust, in a business entity, affects liability, exposure, and estate planning. I'm not going to give you specific legal advice because I'm not a lawyer and your situation is unique. But I will tell you that wealthy people think carefully about asset protection structures. They consult with estate planning attorneys. They set up trusts where appropriate. They use business entities to separate personal and business assets. The goal is to avoid single point of failure. You don't want one lawsuit or one bad decision to expose all your assets. You create firewalls and separation so that problems in one area don't spread to everything else. Beneficiary designations are simple but critical. Your retirement accounts, life insurance, everything with a beneficiary designation, make sure they're up to date. Make sure they align with your wishes. These assets pass outside of your will, so the beneficiary designation controls where they go. Many people set these up decades ago and never update them. Then life changes, they remarry, they have kids, and the old beneficiary designations create problems. Review them regularly. If you own a business, key person risk is huge. What happens if you or a critical partner dies or becomes disabled? You need life insurance, disability insurance, buy-sell agreements, succession plans, documentation. I've seen businesses that were worth millions become worth nothing because the key person died and there was no plan. Don't let that happen. The wealthy plan for these contingencies. Finally, governance and documentation. Keep good records. Document important decisions. Have operating agreements if you're in business with partners. Have a will and ideally a living trust. Have powers of attorney for financial and healthcare decisions. None of this is exciting. It's all boring administrative work, but it protects your wealth from foreseeable disasters. The wealthy do this boring work because they know it matters. Now let me give you some numbers that should change how you think about protection. First, drawdown math. If you lose 30% of your money, you need a 43% gain to get back to even. If you lose 50%, you need a 100% gain. If you lose 60%, you need a 150% gain. The math of losses is brutal. This is why rule number 1 is never lose money, and rule number 2 is never forget rule number 1. Avoiding big losses is more important than capturing big gains. Second, sequence of returns risk. This affects retirees especially. The order in which you experience returns matters enormously if you're withdrawing money. Imagine 2 retirees. Both start with $1 million. Both earn an average of 8% over 20 years. Both withdraw $50,000 annually. Retiree A experiences good returns early and bad returns late. Retiree B experiences bad returns early and good returns late. Even though their average return is identical, retiree A ends up much wealthier than retiree B. Why? Because retiree B had to sell shares during the early downturn, locking in losses, and had fewer shares remaining to benefit from the later recovery. This is why the 3-bucket strategy makes sense for retirees. Bucket 1 is cash for 1 to 2 years of withdrawals. You never have to sell stocks to cover near-term expenses. Bucket 2 is bonds for years 3 through 10. Bucket 3 is stocks for year 11 and beyond. This structure protects you from sequence of returns risk because you can ride out market downturns without forced selling. Third, the power of dividends and long holding periods. I mentioned earlier that Coca-Cola's dividend to Berkshire grew from $75 million to over $700 million. That's a tenfold increase over 35 years, about 6.7% annual growth. But here's what's remarkable. We didn't have to do anything. We just held the stock and let the company do its work. The dividend grew because Coca-Cola's business grew, because they increased the dividend every year, because we reinvested and bought more shares over time. That's the magic of quality businesses held for long periods. The compounding happens automatically. You don't have to be smart. You just have to be patient. If you understand these numbers, if you internalize the math of losses, sequence risk, and compounding, your behavior will change. You'll become more focused on protection and patience. You'll worry less about hitting home runs and more about avoiding strikeouts. So let me wrap this up with a practical roadmap, a checklist you can follow to protect and grow wealth the way wealthy people do. Number 1, stay within your circle of competence. Only invest in things you understand. If you can't explain how something makes money in a few sentences, don't own it. Number 2, demand a margin of safety. Never pay full price. Always insist on a discount that protects you if you're wrong. Number 3, maintain cash reserves. Keep 1 to 2 years of expenses in cash or cash equivalents so you never have to sell at the wrong time. Number 4, avoid leverage.
Don't borrow to invest except possibly for a home mortgage you can truly afford. Leverage is how fortunes are lost. Number 5, own quality. Focus on businesses with durable competitive advantages, strong management, and shareholder-friendly capital allocation. Quality protects you. Number 6, minimize costs and taxes. Use low-cost index funds unless you have genuine expertise in stock selection. Hold investments for long periods to defer taxes. Every dollar saved in fees and taxes compounds for you. Number 7, diversify intelligently. Own enough different things that no single failure can destroy you, but not so many that you lose track. A mix of stocks, bonds, and cash makes sense for most people. Number 8, rebalance systematically. Set target allocations and rebalancing bands. This forces you to sell high and buy low without emotion. Number 9, stay calm during crises. Don't panic sell. Maintain a watch list of quality businesses. When fear is high and prices are attractive, have the courage to buy. Number 10, protect with insurance and structure. Adequate insurance, proper asset titling, estate planning documents, beneficiary designations, all the boring administrative work that protects wealth from foreseeable disasters. Number 11, think long term. Wealth is built and protected over decades, not months or years. Train yourself to think in decades. Our favorite holding period is forever. Number 12, read and learn continuously. I still read 500 pages a day, mostly annual reports and business books. The more you learn, the better your decisions. Knowledge compounds just like money. That's it. That's the playbook. It's not complicated. It's not exciting, but it works. The wealthy protect their fortunes by following these principles consistently over long periods of time. They don't try to get rich quick. They don't speculate. They don't use excessive leverage. They don't panic during crashes. They don't chase hot tips or fads. They just buy quality, hold it, minimize costs and taxes, maintain liquidity, and stay patient. If you do these things, if you follow this playbook, you'll protect whatever wealth you've built, and you'll likely grow it substantially over time. Not because you're brilliant or lucky, but because you're disciplined and patient. Charlie Munger used to say the first rule of compounding is to never interrupt it unnecessarily. That's really what all of this is about. Putting yourself in a position where you can let compounding work for decades without interruption, without panic, without forced selling, without big mistakes. Protect your capital, own quality, stay patient, let time do the heavy lifting. That's how fortunes are protected. That's how wealth lasts generations. That's how you win the long game. Thank you for your time today. I hope this has been helpful. Now go out there and protect what you built and build what you want to protect. And whatever you do, remember, never lose money and never forget that rule. Good luck to all of you.